Hi everyone, this is Jitan here and welcome to another episode of TradersTV. Now this week we've had a special request from one of our viewers called Clyde, and we're going to be talking about how to trade the news. We're going to be talking about how we at Learn to Trade use the news to our advantage and whether you should consider using it as well. So without further ado, let's get to it.
So learning to trade the news. Before we start looking at specific strategies on how to trade the news, let's first understand a little bit more about news itself. So what is news? Well, news can form part of economic calendar releases such as retail sales, inflation. So typically traders, before the week starts, will already know what economic releases there are out during the week. So UK inflation data, UK retail sales numbers, services PMI, manufacturing data, ECB press conference. It could be US dollar CPI data, retail sales. Across all the currencies, there's a multitude of economic calendar releases throughout the week. Any economic calendar will tell you what announcements to expect for the week ahead. There's also political events such as elections, which are newsworthy as well. And elections can last for some time as campaigning gets underway. And again, trading the currency market, the global markets, we have to stay abreast of what's happening in Japan, the UK, the Eurozone, the US. Okay, so we look at elections all around the world because that can create volatility and can be classed as a news announcement. We also have unexpected news announcements, so events such as a war, terror attack, or just political uncertainty. So we've seen a lot of political uncertainty recently within the UK, and the government, the Conservative government, struggling somewhat. And that has caused volatility in the British pound. In other countries as well, political uncertainty will affect the currency. We also had recently the South African rand was quite affected by the things happening in Jacob Zuma's political party and the uncertainty around that. So we have planned news announcements, which are like economic calendar releases, but then there's other announcements that are unexpected, that we may just wake up in the morning and suddenly something has happened overnight and the market's already moved and we have to kind of position ourselves accordingly, right? So those are the different kind of news announcements that we'll be dealing with. So who trades the news? Well, the first question to ask yourself, do professional traders trade the news? And the answer is no. Okay. Professional traders do not trade the news announcement. We'll speak in a little while on how professional traders actually use news to their advantage, but they're certainly not trading the news announcement. However, do retail traders trade the news? Yes. Okay. A common question that we always get is, how do I trade the news? How do I get into the mood? Because people will see a trend forming, okay, and then suddenly on a news announcement you'll just see a big spike higher, and of course people want to know, well, how can I get into that move? How can I trade that big move there? Okay, now just one thing to bear in mind is that you can do that as a retail trader. If you're trading a small account, and you're risking a small amount per trade, then this seems enticing. But realistically, as a professional trader, if you're managing, £500,000 of your own money, okay, or maybe even more than that, if you're risking £1,000, £5,000, £10,000 per trade, would you trade an unexpected announcement like a news announcement? You probably wouldn't, okay. So the key difference is that retail traders actually try to trade the news announcement, whereas professional traders use the news announcement to their favor. There's a big difference in the approach. Of course, which side do you want to be on? I imagine you want to be on the professional trading side, because the great thing about trading is that it's a level playing field. We're all looking at the same charts. Institutional traders are looking at the same charts that we're looking at. However, they have more resources, they have more discipline, they have more people helping them to do the job than the retail trader. So we have to understand some of those slight differences. So as retail traders always look to try and trade the news announcement because they're looking for the quick wins, they're looking for a quick reward, almost like a gambler mentality, with professional traders use news announcements into their favor. Okay, not necessarily looking to trade the news announcement, but helping it to manage their portfolio. Okay, so how do we trade the news? Well, one thing to bear in mind is that markets move on anticipation and expectation rather than the fact. So what that means is that markets will forecast that a central bank is going to increase interest rates in the next few months based on data that they are looking at. Okay, because remember, central banks, they have a certain mandate that they have to follow. So economists and other analysts can look at those mandates, analyze that, and then they can build an anticipation or expectation of an action potentially happening. So that's how markets move. A lot of people think markets move based on a big news bar on a retail sales number, and you may get some volatility, but it doesn't start or end a trend. Okay, so markets move on anticipation and expectation, and generally when the fact comes out, if it's already been expected, that's when professional traders will actually start to bank their profits, and that's the key difference. Professional traders, they'll build a position on their anticipation and expectation of an event happening. And then retail traders would then get in once the event has happened. But then, of course, when you're getting in when the event has happened, all that's happening is that professional traders are selling or buying back their positions to you, because they're banking their profits whilst you're getting into a fresh trade pretty much on the wrong side. So trying to predict the reaction of a news announcement is really a mug's game. Feel free to be one if you want, but I imagine after this, you're going to do things the right way. So just remember this, professional traders are already in the move before a news announcement, and they look to get out or even add to the trade after the news. Now, of course, on an unexpected news announcement, when you wake up in the morning, something's happened overnight which was unexpected, then fine, they have to scramble their positions and adjust accordingly, but by that time, you've already missed the move anyway, okay? But looking at planned economic releases, one thing to bear in mind is that professional traders are already in the move, before the news announcement, and they'll be looking to get out or add to the trade after the news announcement has already happened. So it's a big difference from the professional trading community and the retail trading community. So how do we trade the news? Let's have a look at a couple of plays that we can look at. So if we have a news announcement, okay, and it's a bad news announcement and the market decides to move up anyway, then that is a sign of a very strong market. So we can use that to our advantage to either add to our trades or maybe even build some fresh positions within that market. Because basically what's happening is that we have a bad news announcement, and we've had some negative US data, so retail sales hasn't been that good, manufacturing hasn't been that good, but the US dollar has kept on going up. Okay, even though we've got bad news announcements, the market keeps on going up because people are just willing to buy the US dollar, okay, at that current moment in time. There may be another reason why the market is going up, more likely the fact that the Fed could be increasing interest rates, but the key thing is, if we're analyzing the price action and some of the planned economic releases, it will give us a good indication of the strength or weakness of the market. So if the market moves up on a bad news announcement, that implies it's a very strong market. We'll be looking to either build fresh positions within that or looking to add to the positions if we're already in that trend. On the flip side of that, if the market moves down on a good news announcement, then that's the sign of a very weak market. It's basically telling us that no matter how good the news is, traders are still overall bearish on this. They still want to get to the short side because it's just a very weak market. And we've seen that with the British pound. On the recent increase in interest rates from the Bank of England, the market sold off. It had been going up since then because the professional community anticipated that and they got into the move. And then the news announcement came, Bank of England increased interest rates. The retail market will look to buy. If you're buying from someone else has to be selling it to you. The professional trading are selling you their positions because they're looking to come out of trade and bank their profits, right? So if the market goes down on a good news announcement, it's telling us that it's a sign of a weak market. We either want to add to our short positions if we're already in this market, maybe want to consider getting to the short side, or if we're long on the trade, then maybe we need to consider tightening up our stop losses or maybe cutting the trade if things aren't looking too rosy. So in each one of these scenarios, it just helps us to understand the strength versus weakness. And remember, when you're trading currencies, yeah, that's what you're trading. You know, if you're trading something like the euro against the US dollar, okay, if you're going to buy this, then you're saying that the euro is going to strengthen, yeah, and the US dollar is going to weaken. So your best trades are going to be the ones where one currency is strong, the currency you're buying, and the other currency is weak, yeah, the one that you're selling, because it's in a pair. So understanding the strength and weakness, it can be very, or actually is very important. So this is just one play, and it's called a divergence play. We're looking for the divergence in what the news announcement is and how the market reacts. If the news announcement is bad, but the market moves up, it's a sign of a strong market. If the market goes down on a good news announcement, it's a sign of a weak market. So we can use this strength and weakness to our advantage by either adding positions, cutting positions, or even getting into fresh positions. So that's one type of way on how we would use the news to our advantage. Another way is the expectation play. So this is basically where you're looking ahead, right? And let's say, you know, there's a high risk central bank news announcement in a few weeks' time. So you're looking ahead to the high impact news announcements. Now, we can learn a lot from how price moves in the run up to that event or to that announcement, okay? So if, for example, the market goes nowhere in the run up to that announcement, so it's just going sideways, there's no real buying activity, no real selling activity, it's almost ranging in a consolidation, then it's basically telling us that no one is willing to take a position on this market because the outcome is just that uncertain. Yeah, it's really uncertain. No one's looking to take a position on that market, so it doesn't make any sense for us to take a position. Okay, we're not going to move the market. It'd just be a gamble getting into a move like this, where the rest of the market, $7 trillion market, doesn't have a clue either. Okay, so another scenario for the expectation play is if traders are pushing the market higher or lower before the news announcement, then that means they are pricing in a higher degree of certainty on that potential outcome. Because here's the thing, on a central bank announcement, they have a certain mandate. If, for example, inflation is getting too high, yeah, the only tool the central bank has to stop inflation getting too high is to increase interest rates. We've seen in some countries that, like the UK for example, inflation has been very high, well over the Bank of England target of 2%, it's around 3.1%, okay? So that's why the Bank of England have increased interest rates. So little things like that, traders start pricing in a higher degree of certainty on the outcome, and that's what we saw recently, and we'll look at the charts in a moment so we can see that. So this is the expectation play. Yep. Having a look at the high risk announcements ahead, so central bank news announcements are a big one, and seeing how the market moves in the run up to that. Are people or are traders buying the market? Are they selling the market? If they are doing either of those things, that means they're pricing in a high degree of certainty on whatever the outcome is going to be. So in that respect, we can join them and keep on trading in that direction. And then we can join the professional traders, and when the news announcement comes, we either bank our profits or we even add to our positions. Rather than the retail trader who doesn't know what they're doing, they just see one big bar on a news announcement and they think they can try and get in. Not understanding that during news announcements, spreads typically widen because the market gets a little bit more volatile. So, you know, you may be trading something at a 2 pip spread and suddenly it gets in at a 5 pip spread. So you're first of all getting in very late if you're trying to trade on that news announcement. And by the time you've got the news, by the time you get filled, it's going to be very late because as a retail trader, you're at the bottom of the order book. Okay, so those are just the two ways that as a professional trader we use the news to our advantage. Okay, so we're not specifically looking to hit buy and sell when a news announcement comes out, but we should already be in a position in that market, okay, and looking to either bank our profits or add the position after the news event, depending on which way it goes, right? So those are the two different ways, divergence play and expectation play. Let's have a look at charts so you can see this in real time on a recent example. So we can see here on the chart of British pound against the Aussie dollar, this big seller bar here was the Bank of England news announcement. Okay, this is where the Bank of England increased interest rates to 0.25%, or by 0.25% to 0.5%. Okay, so that is usually good for a currency. But remember, the market had already been moving up prior to that. Traders were already anticipating that event. Yeah, which is why the market was going up. And you can see this across the board, even something like pound against the Canadian. Yeah, the market was going up in anticipation of that news announcement, and it sold off on the fact. So, you know, if we look at some of these other markets like pound yen pushing higher as well, sold off on the fact. You know, pound dollar. Okay, not really much here going on with pound dollar. They're largely going sideways, and then it sold off on that news announcement, and it's still going sideways. Okay, but we can see a majority of those pound crosses, we had the strength in the move, and then we sold off after that news announcement. So we should already have been involved within those cross rates, like pound Aussie, before this day even came ahead. Yeah, we should have been looking to buy some of these dips here, some of these dips here, and some of these dips here, and maybe intraday on the way up. So again, it depends what strategy you have, but you've got a directional bias here. Traders are anticipating a potential event here, so they're bidding up the market, they're pushing it higher. We want to join that. When the news announcement comes out, that's when we're looking to take our profits off the table, just like the professional traders would. Okay, so this is where you have that expectation play, okay, with the news announcement. But within this as well, you know, a lot of these pound crosses were going up, even though we were getting negative construction PMI reports, we were getting negative manufacturing reports, mixed services PMI. So even during these periods of time, we were able to see that the pound was actually still going up, even though we were getting negative news announcements on the lower tier data. Yeah, like manufacturing, construction, and so on. Lower tier for the UK because it's not a big industry for the UK. But that gives us insight in the fact that traders are just willing to buy this. So that's how we'll be looking to use the news to our advantage and trade accordingly.
So I hope you found that video to be of use. If you want any more information, if you want to interact with one of our traders live one-to-one, then visit the link below and attend one of our free Forex trading workshops. In the meantime, watch out for our next video where we're going to be talking about Forex market correlations. See you next time.